What is the DuPont formula and what are some of the assumptions employed as part of that formula? Well, to begin with, the DuPont formula is really an assessment of return on equity. It is used to assess or create a comparative metric between businesses to determine how efficient or how productive a business is with regard to the assets that it has. So with that being said, there are numerous assumptions that must be made in order for the DuPont formula to be useful. Well, the first is if it's a comparative measure between the performance of business units or whole businesses within a given industry, you must be comparing businesses of like nature. The formula is based itself on the sale of products. Okay, that is, service industries are less relevant because, once again, sales is based upon an hour of time rather than the actual delivery of a product and what goes into it. With that being said, if you use it to compare non-like businesses, once again, discrepancies arise. And the best way to demonstrate that is to go through the metrics that are a part of the formula. So first, we look at net profit margin. So when you can see in the analysis formula, the NPM is the first element of the component. And at the very bottom, we've broken this down again into its variable elements for better understanding. So net profit margin is a combination of net income divided by revenue. Okay, so net income, that's net of expenses. So you could look at it in a way as profits before taxes and things like that related to total revenue. Now, if you break down this metric as a comparative measure, it comes out to be a percentage. But we know that not all net profit margins are made equally. One type of business may have a very high percentage or net profit margin, but the total profits are lower than in some industries. So size is a big variant, a factor there. So you're making assumptions in using this that you're comparing businesses of similar size. Next, asset turnover. Asset turnover is a sales divided by your average total sales. So basically, how quickly does your inventory of a product turn over, and you're using as the denominator the average over a period of time of the amount of sales you have over that period. So at what rate are you turning over your inventory? Once again, this makes assumptions that industries, that businesses within a given industry are going to be similar. If you turn over a set of inventory on machines that cost $100,000 to $1 million each versus the turnover of inventory on $1 smaller products, there's going to be a huge discrepancy there. One, there's probably going to be more seasonality to sales. Two, the sales are probably going to relate more closely to brand. Three, these larger items are probably marketed towards businesses rather than consumers, which can be subject to varying degrees of change given the external and internal factors that can affect sales processes. So once again, just the very nature of using this metric has the assumption again that you're comparing businesses of like nature. And then lastly, the equity multiplier. And this one is probably the most chock full of assumptions. So the equity multiplier is the average total assets of the firm divided by average shareholders' equity in the firm. Well, shareholders' equity, if it's measured in dollar value, is a constant denominator. So that will be the same within any given industry. But your average total assets, the value of an asset is very difficult to determine, particularly when you have different types of assets, such as goodwill or brand value or intellectual property value, things of that nature. So if you're using this as a metric, again, you're coming up with a percentage of the value of one thing to another, where one of the valuation metrics is very difficult to assess. So if you're not comparing businesses that have very similar types of assets, again, this formula is not going to be as useful. So with that being said, these are the core assumptions in the DuPont formula. And if you look at the expanded return on equity approach that you see below the formula for it, you can see how these different metrics apply and are used as part of this formula. But hopefully this helps you understand what assumptions are relevant, necessary, and a part of implementing or employing the DuPont formula or analysis.